right? So there's limitations on that, right? And banks, they don't really like short-term mortgage, right? The only reason they can offer you 3%, 2.5% is they look at it 25, 30 years.
Oh, that's
The
true.
money keeps coming in, right?
That's right.
And they don't have to do anything,
That's right.
right? And they don't like to do they're not gonna, the bank's not gonna give you a 3% mortgage for 6 months. You'll have huge penalties, right? Unless it's fully opens and whatnot, right?
Right.
The interest rate is different, right?
I see.
And then this one is what I call asset-based. So the banks, what they call is they are credit-based.
Oh.
So they look at the borrowers, whether they have sufficient income or they have sufficient credit to get the loan,
I see.
right? And then they look at the asset.
Right.
But for me, I look at asset-based. I'm mostly interested on the property itself. If the property worth the money, and if the project is profitable, okay, and then I look at the credit secondary. So it's different strategies, credit-based and asset-based. All the private lending out there, they are basically asset-based.
Would you say credit-based as in like evaluate the borrower if they are capable of returning the money?
Yes.
Or, yeah.
So basically, credit-based, like whether they can pay the money back over 5, 10 years. Do they have a stable job?
Right.
Do they have stable income to afford the mortgage payment every single month?
Right.
For me, it's short term, right?
Yeah.
I only need to make sure they can pay the interest payment for the next 6 to 12 months.
Right.
Okay? And if the project is profitable, I'm not too concerned.
Right.
Like example, if this project is profitable, I know there's significant margins. But if the borrower default, let's say he doesn't have money to pay me interest, I can foreclose, I can take the property. I
Oh.
may actually make more money that way.
Oh, I see.
If I
I see.
foreclose. Because this project is huge profit margins.
Yeah.
If
So
I take the property, I can still sell to cover my own capital investments, and in some cases, I may actually can make more.
so you're still in a way like insured by
Yes.
still getting the property
Exactly.
if anything goes wrong.
Exactly.
I see.
Right.
Yeah.
That's why this is secure by a property, right?
Right.
And there's more than that. I'm going to talk about that a bit later, right?
Right.
But this just focused on the asset, the collateral itself,
I see.
right? Okay. And then yeah, they have generous margins, right? So if they can make 30K, they are willing to pay $5,000 interest to get the project done. They would
I see.
rather make 25K than nothing.
That's right.
That's why they're willing to work with private lenders all the time.
I see. I see.
And it's very common in the real estate investment world, right? Okay, so yeah, passive wealth buildings, right? So basically, when I look at these strategies, I consider this really sustainable, solid return with minimal risk. Sustainable meaning that no matter what the market condition is, when I talk about market condition, I'm talking about the stock market. When the stock market go up or down 20%, it doesn't really impact the real estate market, right? The real estate market usually react a lot slower. Like if the overall economy is coming down,
Yeah.
the stock price will come down first and
Yeah.
hard. The real estate price may come down, it may follow, it's a lot slower.
Mhm.
If you go back to 2008, where in the subprime mortgage disasters
Mhm.
in the US, the hardest hit market dropped as much as 50% in a period of 18 months.
Mhm.
18 months, 50%, right?
Right.
And this time is 6 to 12 months. So we have time to react.
Oh yeah.
And in most cases, there's still sufficient margin for you to tolerate that significant drop in the house price.
Mhm.
And then later I have a slide showing you what I mean by that. Right?
Okay.
But for now, let's consider the light. So that's why I love that. I don't have to lose my sleep. The stock market suddenly dropped 500 points. Right?
Okay.
So it's like last year, I don't really care. The stock
Right.
market was like fluctuating like crazies, right? Like to me, I'm still getting my interest income every single month.
Right.
So
Right.
that's why I like about this, right? Monthly income generators, right?
Mhm.
Or you can use this as nest building, meaning you get the monthly interest and then you invest in. You want to keep the compounding effect.
Mhm.
Compounding is very, very powerful,
Right.
right?
Right.
And this is completely passive. And I'll show you my structures so that you know why it is completely passive.
Okay.
Yeah, to me, it's an excellent alternative investment strategies. And I have yet to find something that will give me comparable risk versus return ratio.
Mm.
Okay, so if you have something like that, let me know. I'm interested. Okay.
All right.
All right. So just give you an idea of what does it mean, right? Let's say you invest in GIC versus private mortgage.
Yeah.
4% versus 10%. Just an idea, right? At 10%, you can double every 7 years. Okay?
Yeah.
The rule of 72, right? Divided by the interest rate of return, so you can double your money around roughly 7 years, right? And then by year 17, at 4%, yeah, you're doubling your money, right?
I don't think you can get 4% GIC.
No,
right?
no, I'm just saying be
Yeah.
generous on that. Maybe
Yeah.
it's literally it's like 1.5%, right?
Yeah.
Anyway, as a comparison, like by year 17, you have 5x of your capital already.
Mhm.
So that mere 6% is huge difference on the long term.
Right.
That's why I say compounding is very, very powerful.
Right.
So if you want to use this as a nest egg building strategy, which is what I'm doing right now, right?
Mhm.
Then you can really achieve a retirement plan quicker and more solid, like more definitive, right?
Right.
So yeah, so just to show you the difference on that percentage. Okay, so now here I'm gonna show you the structures.
Okay.
I want to give you an example what a typical transaction looks like, okay? So in every single transaction, there are basically 3 parties involved. First of all, there's the board,
Mhm.
or the investor that's buying the house to flip,
Yeah.
okay? And then there's the lender, or you or me in this case, who is lending out the money.
Yes.
And then there's a middle person, either attorney or escrow agent, what they call in the US. Basically, there's a middleman
Yeah.
handling the transactions, right?
Right.
Okay. So what happened is, at the beginning, the board investor, they do their own marketing. They identify properties that is profitable through their own ways of finding distressed sales, right? And then they do their own due diligence.
Yeah.
They think this is a profitable transactions. Then they will prepare what's called a private lending package. It contains all the information. What's the purchase price? What's the rehab estimate? What's the address? What are you planning to do to the property and stuff like that? Okay? And then they send this private lending package to the lenders that they work with. Okay? And then lender, like me in this case, I'm gonna take that. I'm gonna do my own due diligence, right? I don't take their word saying, okay, this is how much it's worth, that's great. I don't do that, right?
Right.
You have to do your own due diligence to cross-check all the information that the board is providing you,
Okay.
right? You have to be able to determine whether this is as profitable as what the board says.
Right.
Okay, so this is a very important step there, right? Doing your own due diligence, right? And then after that, you negotiate the term with the board based on what you find. What is the interest rate? What are the risk level? How long is the durations, right? Do you want to get monthly interest or at the end? Or you want to have some interest reserve collected at the beginning and stuff like that. There's a lot of different ways to negotiate the terms, right?
Right.
And then, if the lender and the board can agree on the terms, then we are ready to close.
Mhm.
Okay? So what happened is, once we go to the closing date, the lender send their money to the attorney, and the board also send their money to the attorney. Like for me, I do not do 100% financing, meaning I only lend up to 80% of the cost.
Okay.
So I always want the board to have some financial skin in the game.
Okay.
Okay, if they don't have any financial skin in the game, to me, they are not confident enough about the transactions,
Right. Right.
right? And I don't really want to participate in those transactions,
Right.
right? So yeah, so they basically, the down payment is how much money I'm lending, right? Send everything to the attorney, and then the attorney, what it's gonna do, basically, it will execute all the legal documents,
Right.
okay? And then the executed document will be sent to the lender as the collateral. So the document, once they sign, they will send the document to the land title office,
Yeah.
record it on title, and then once we record on title, they get the original back, and then sent to the lender as the collateral. Okay.
I see.
At the same time, the board, they take title, basically they own the property now,
Yeah.
and then they start the renovations.
I see. I see.
Okay, so this is the first half of the project, meaning at the beginning where the money is being lent out.
Right.
Okay, and then after that, the board does their own thing, renovation, and then we start collecting interest payment during those time periods, right, where the money is out, right?
Right.
And then, so how does it look like at the end of the project? Okay. So basically, the board finished the renovations.
Yeah.
They put the property on the market for sale, like in the typical, they basically sell this to retail buyer now, okay?
Right.
And then they find potential buyers. They enter into a purchase and sale agreement,
Right.
okay? And then the buyer is gonna do some inspection and whatnot, just typical, like you buy a house, right?
Right.
And then basically, when they're ready to close, the attorney is gonna do a title search on the property.
Yeah.
And it's gonna see the lien, right? Once you see it, he's gonna contact the lender. Okay, we are trying to pay off this particular mortgage or particular lien on title.
Yeah.
Can you give me a payoff letter? Then the lender will pay us that. Okay, this is the capital amount, and this is how much interest has been paid, and how much outstanding and whatnot. And this is the full amount I need in order to pay off this particular mortgage. Okay, they send this to the closing agent. Okay, that's good. So attorney will take the money from the buyers. Wherever the buyer get the money from, we don't really care whether it's financing or it's in cash. We don't really care, right?
Right.
So money is sent to the attorney, and then what the attorney is going to do is going to distribute the monies. They will distribute first to the lender because they're first positions.
Yeah.
Okay, make sure that can cover all the amount. If it's not sufficient to cover the amount, the lender is not going to release the mortgage. It's not going to sign anything to release, right?
Right.
So you distribute the money to the lender, and then the rest to the board. This is their profit. Okay? And after the money is received, then the lender is going to sign what we call a release of mortgage or a satisfaction of mortgage. And that will be sent back to the attorney, and then the attorney will record it on title, the lien is removed. Then this new buyer got a free and clear title now.
I see.
Okay? So that is the entire transaction from front to back in a nutshell, right? There's more detail to that we'll cover later on the later workshops, right?
Right.
Okay, so this is what it looks like on typical transactions. So now EPI, basically my company, is called EPI. It stands for Ethical, Professional, Innovative.
Oh.
That's my company name. So
Okay.
I forgot to mention that at the beginning. Anyway, so this is what I'm offering my services, EPI private lending. Okay, so basically what I'm saying, I can offer people 8% plus rate of return on their money, and then you just sit back,
Yeah.
get the interest income, and I do all the work because I have the knowledge, I have the experience, I know exactly how to do that. So how does that structure work, right? I'm gonna show you what does that mean.
Okay.
So basically very similar to before.
Mhm.
At the beginning where we buy the property, the board still does the same thing, right?
Yes.
Buy the property, do the due diligence, send the private lending package, right? Then in this case, there are two lenders, EPI, which is me,
Yeah.
and then whoever that's interested in partnering with me to lend the money together.
That's right.
In this case, maybe you, right?
Yeah.
So what happens is they send it to me, then I'm gonna do the due diligence.
Yeah.
I'm gonna review all the numbers. I'm gonna make sure this is a solid, profitable transactions, okay? If it passes my due diligence, right, then I'm gonna send a summary to my passive investor or to my client.
Right.
Okay, this is what I look at, this is why I think this is profitable, right? Is this something that you feel comfortable in moving forward with me together on this one?
Yeah.
Right, since I serve it in you to a silver platters. Basically, everything is done.
Right.
I do all the hard work, right? Okay, so let's say if you're ready, you want to move forward. This is the basic structure that I'm offering. So my investors, they will fund 80% of the loan amount.
Okay.
Okay, and then myself, I'm gonna use my own money to fund 20% of the loan amount.
Okay.
So basically, I'm investing alongside my investors
I see.
on every single transactions. I'm financially committed myself.
I see.
Okay, that's why how I show I'm so confident about every single transactions,
Yeah.
because I'm financially committed. It's the
Right.
same thing why I want the board to be financially committed on every single transactions, right?
Right. Right.
So when we do close, we send the money directly to the attorney. So
Yeah.
no money goes through me. Okay?
Okay.
I send my money to the attorney, and then you send the money to the attorney. Same thing, the board send the money to the attorney, just like before,
Right.
right? And then here's the important part. And then the attorney is gonna record the mortgage. But then there are actually two liens on title.
Mhm.
So I'm offering a first lien to my investors.
Okay.
Basically, they take first priority,
Right. Right.
okay? And then I am behind them. I'm taking the second priorities.
Uh,
So if anything happens, let's say if this default,
Yeah.
the property is sold at the foreclosures, the proceed from the foreclosures, the money will go to first position first.
Okay.
And then anything remaining, go to second.
Okay.
And anything remaining, go back to the board.
I see. I
So
see.
what that means is, if anything happens, I'm the one that's gonna lose the money first,
I see. I see.
because I'm in second positions.
Right.
All right, that is how I structure it to give my investor the confidence
Mhm.
that I'm on the same boat with them, and I have even more financial interest in making this successful than the first position, because I'm behind.
Right. I
Right?
see.
So this structure is why I believe this is completely passive, because you can trust me in doing the review.
Right.
Because I'm on the same boat, and I'm second position, I'm behind you.
Right.
Right? So, and then of course, if you want to look at the detail model, I can provide everything. I have no problem sharing of those. Depends on where you want to sit back,
Mhm.
or you want more hands-on and review it with me together, right?
Okay.
All right. So this is, I don't think anyone is doing that. I don't think you can find anybody in the industry is doing that.
Okay.
And even like when you go to like financial advisors,
Yeah.
ask them if they buy the stock that they're recommending you. Like when you go to the bank, when they recommend you to buy a mutual fund,
Right.
do they actually buy those?
Yeah, I don't think so.
Right?
The mutual funds are not very
That's
good.
exactly
yeah.
like,
Yeah.
if you don't even invest on the product yourself,
Yeah.
how can you recommend people to invest in that one, right?
Right. That's right. Yeah.
So, anyway, so that's my belief, right? So I always invest on stuff that I bring to the table myself.
I see.
Okay? All right. So same thing, at the end, it pays back, right? So a borrower comes in, and then the attorney is gonna see 2 liens on title. And then get the money, pay off the first lien first, and then the second, and then the borrower. Same thing.
Don't you make additional pay money from doing the research, doing the work that you do as your company?
That's why I'm gonna show you how I structure everything later,
Oh,
right?
sure.
So I think this is on the next slide, right? Okay, so I think it's in the next slide. So this just gives you a more idea on what exactly the exposures.
Okay.
By structuring this way, right? So say we have a property, it's worth $100,000.
Okay.
After it's fully renovated.
Okay.
Okay? And the all-in cost is $70K, meaning the purchase and the renovation cost is $70,000. So basically, they have a 30% profit margin for the investors.
Right.
Okay? So now for this, we are only landing at 80% loan to value.
Right.
So the loan amount will be 80% of this numbers, which is $56,000, right?
Yeah.
So $56,000 is the loan amount.
Okay.
And then the board is contributing $14,000.
Right.
Okay? With this loan amount and 80 and 20% split.
I see.
So the investor is, my investor is doing 44,800, and
Yeah.
I'm contributing 11,200.